I'm Alan Kenny, Managing Editor with REIT.com, and I'm in New York City for REITWeek 2012, NAREIT's Investor Forum. Joining me is Arthur Hurley, Vice President and Senior Portfolio Manager with Columbia Management. Arthur, a year ago, the big story in the REIT industry was the potential for M&A activity. How have those prospects changed between then and now?
I think that there's a number of reasons why M&A activity maybe can't accelerate too much at any given time. And it takes time for these deals to sort of really come together. And the first reason is really the cost of capital. I think that and access to capital. I think that while today there's private real estate companies that are still having some trouble gaining access to capital, most public companies have a pretty good array of options when it comes to accessing both equity and debt. And I think that gives them more options than maybe falling back on some type of M&A activity. I also think that valuation is a big reason as well. While we do have some valuation differences between companies that are doing the same things, most of those differences have to do with companies that are either downtown Class A owners of real estate versus, let's say, suburban Class B owners of real estate. That's really where you're seeing kind of those differentiations in valuations. And there's not many owners of Class A downtown space that are looking to diversify into the suburbs right now. And then the last reason really is timing. Timing is everything. And for M&A transactions to take place, you need willing sellers and you need motivated buyers coming together in some pretty complex deals at the same time, and it really takes time for those things to take place. So again, I do think that you're going to see M&A activity throughout time within the commercial real estate, within the REIT space, but again, it's going to take more time.
And we're at the midpoint of 2012, really. What's been the big story, you think, in the first half of the year?
I'll take the liberty to touch on two things. I think that one is REIT conversions has been kind of a big story from non-traditional owners of real estate. Over the past few years, we've had timber companies that have adopted the REIT structure for its efficiency. And now what we're seeing cell tower owners adopting the structure. We're seeing document storage owners adopting the structure, and data storage owners as well. I think that's one big thing, but I really think the biggest thing that we've seen in the first half of the year is really how well REITs have performed in this new normal economy. And really new normal has come to mean slow structural economic growth. And REITs have performed well. In fact, the first quarter of this year, we saw internal growth from the group that was some of the best we've ever seen. And I think there's some reasons behind why REITs benefit in this environment worth touching on. First of all, in this environment, you have employment growth that is just enough to create incremental demand for space, but at the same time, not so much that there's this demand, not so much demand that we're seeing development increase, and not so much demand within the economy that we're seeing interest rates increase. So we're seeing low borrowing costs for the group. And we're seeing a yield that is competitive to other investments as well in this environment.
Now let's look ahead 6 months. What's the big story in the second half of the year?
I think we'll continue to see REIT conversions from kind of non-traditional owners of real estate, non-traditional leasing companies. And I think that will continue to garner some headlines. But most importantly, again, I do think that you're going to see REITs performing very well from a fundamental perspective in the second half of the year in an environment that continues to be kind of this new normal or slow relative economic growth. And I do think that what you'll see is this internal growth that is attractive, but additionally what you'll see is these companies continue to gain share. And it's worth keeping in mind that REITs really are the owners of some of the best properties in the country, in the best markets in the country, and they're run really by some of the best property managers in the country. So when growth is somewhat slow from a macro perspective, it makes sense that these are the companies that are gaining share from their competitors.
All right, well, thank you very much for your time, Arthur.
Thanks for having me.
And for more on this and other REIT news and analysis, check out REIT.com.